Good morning, everybody. Welcome to today's Morning Coffee with Mike. Today, we're talking about the perils of blind conviction and to trade with caution. The reason why this idea even came up today was because of one of my friends that I saw tweet recently about a trade that he was in a trade called Palantir. PLTR is the ticker for that one. And the reason why he tweeted about this one was because he had too much conviction in the idea. He believed in the company, he believed in the story of the stock, and therefore he held and he held and he held. And he held on the way up and on the way back down and ended up not making nearly as much money as he could. And I saw his story and it reminded me of a story that I was once in. And I wanted to share that story with you here. So let's go through it. I once believed in the story of a stock. I believe that if I did a lot of research like this guy right here, that I would be able to find the leaders, I would be able to hold them, and I'd be able to make a lot of money as a result. Thus began my quest for the Holy Grail. Now, I searched and I searched and I searched some more. And eventually, the stock that I found was a recent IPO by the name of Alibaba. Back then, that was still now. The ticker for that one is BABA. I traded this one back in 2014. And I'd like to walk you through some of the actions that I made in this particular stock. So, breaks out, and I'm buying that early stage breakout. If you are paying attention to some recent trades, that actually reminds me quite a bit of the recent IPO in ARM, just the way that the chart looked. We'll talk about that later on. But I was buying right there. Believed in the story, believed that this was the Amazon of China. So I'm going to buy this. I'm going to load up. It was one of the first IPOs that I found. It ran up pretty quick. It formed this little bit of a handle right in here. And lo and behold, it broke out again. Earnings was right around the corner, but I was already up on this trade and I decided to add some more there and see what it would do. Price breaks out, and price breaks out in a big way. I start to believe more in my assumptions, my process, and this story of the Amazon of China. My conviction in the trade begins to build right here. And why not? I've been justified. I bought again, and the market has rewarded me. So clearly, I know what I'm doing at this point, or so I'm telling myself. Price begins to run up some more. And within 3 weeks, I'm up 30% in the trade. And I start to tell myself that this is going to be a life changer. Have you guys ever experienced trades like this? If you have, go ahead, comment into the chat, and I will answer your questions as you go. A couple of days later, stock starts to pull in a little bit. Tell myself, psh, little consolidation to be expected, right? You're up 30% in a couple of weeks, testing the 5-day exponential moving average like it did there, to be expected. Price comes back in a little bit more. I tell myself, okay, fine. It broke the 10-day exponential moving average. But I'm looking down here at volume, right? That little bar right there, that's volume. I tell myself, wasn't too bad. Look at this run up back here. Look at all that volume that came in. Look at this volume on the selling. Selling's not that bad. Price is still way above my average cost. I bought in down here. I added some down here. it's still a good amount above my average cost. So I'm going to hold some more. And then here, a successful test of the 21-day exponential moving average. It's time for me to add. And so I add right there, right here, right off the 21-day exponential moving average. This point, I'm in the trade for about a month. Bam! Right off the 21-day exponential moving average, price leaps off. I'm a trading god. I've got this thing figured out now. More conviction in what I'm doing. I have more conviction in Alibaba, and I have more conviction in the story that I've been reading in the news. I've been reading, I've been researching, I've been looking at the earnings and the sales and all this growth. Price is doing precisely what I want. All of my moves have been profitable so far. I'm being rewarded. And so the conviction is building. And price falls for the first time. Tell myself, okay, I can't be right on every single buy, right? Who is? But hey, this looks like it could be forming a potential double bottom, right? For those of you that are familiar with the double bottom, if you are familiar with double bottoms, type into the chat. Let me know if you're familiar with that term. Basically, what a double bottom is it kind of looks like a W. If you traced out a W pattern, I would seeing this as an undercut of this low. So I thought, all right, this is a leader. At this point, I'm already telling myself that this is a leader and that I've got one of these stocks that could change my life. I bought into it a bunch of times. It's confirmed my buys on each time. And I'm telling myself that maybe this is going to be the first base out of here and I'm going to buy on the next breakout. Then a couple of more days go by, week goes by, and then the 50-day moving average finally forms. It gets a strong initial bounce from that 50-day moving average, that red line right there. I'm not adding yet, but this sure is a hold, I tell myself. And the reason why, price pulled back, bounced off of it, did so strongly, closed at the top of its range, uptick in volume, if you can see it down there. So if you notice, I'm finding reasons why this stock is a good idea and is behaving appropriately. Yeah, Pat, this was one of my favorite bases too. If you pull up a recent chart of ARM, ARM, looks very similar to how it looked back here and even in this zone. Let's continue. Another week goes by, and I tell myself, man, oh man, look at how well this is holding the 50-day moving average, right? It tested it down here. It reversed positively, and now it's trading well above the 50-day moving average and above that low. I am right. And bam, up and out of this little consolidation there. Time for me to add, right? It held the 50-day. This is behaving like a true market leader. So what do? We add here, right? And so now let's scroll back the clock a little bit. Remember, I've already bought on that initial breakout from that IPO. I bought when it made this little handle over here. Then I bought off that bounce from the 21-day exponential moving average. And now I'm buying back here. Right? So let's keep it moving. Now, price pulls back in again. Retests the 50-day moving average. I tell myself that, okay, it happens. It's still holding the 50-day moving average, right? Price fell, but it ultimately closed back above the 50-day moving average. Okay, it hasn't broken a rule per se. So, and the story is still intact. This is still the Amazon of China, right? That's not going to change in the span of a month or two. Let's hold. And now it's closing below the 50-day moving average. And that was on a Friday. So it was also closing below the 10-week line for the first time. I tell myself, okay, that's going to happen too. It can rebound, right? Of course it can. Well, at this point, it undercuts all those lows. So my original thesis of this back here turning into a double bottom, that's out the window. Say, dang, I'm back to right around where I made my first ad back here, right? The low of that level is pretty close to where I'm buying back here. And I say, fuck it, I better sell. And so I did. And that's when I start to kick myself. And I tell myself I'm a fool. I should have waited. Uh, I should have waited. And not only that, it waited for me to get out of the trade for it to rally. Right? You ever tell yourself that? Yeah, I would. I used to tell myself that too. And then rallies a little bit more. If it gets back above the 50-day moving average, I tell myself that, you know what? I'll buy it back if it rallies back above the 50-day moving average. This time, if it does, I'll be more disciplined. I should have kept my conviction in the stock, I tell myself. But then it rolls back over, and I tell myself that I'm glad that I sold way down here. Now, price starts to rally back. And every time price starts to rally back, I tell myself, man, every time I think I'm out, they pull me back in. That's what I tell myself on this move. I thought that I was done, but then earnings comes around and I'm glad that I stayed out of that last time. And then it's time for me to do a little bit of post analysis. I'm not even doing the post analysis at this point. I should have been doing my post analysis all the way through. Learn that lesson the hard way. But now that I'm out and I'm finally right for being out and not kicking myself as much, now it's time to go back and do a little bit of post analysis. And if you go all the way back from back here, right, from when I initially bought and then added to the position and being up 30%, this is a round tripper, right? Being up 30%, now you're up 0%. You're adding at the wrong places. You're letting all that conviction be in the wrong spot. I have conviction in the stock. There is no such thing as a good stock. It's only good when it's making us money. The moment that it's not making us money, guess what? It's not a good stock. It's not doing what it's supposed to. So here are some of the lessons that I took away from this. I'd love to hear the lessons that you take away from this. Go ahead, start typing into the chat right now what some of the lessons that you had from this. Number one, it's very easy to talk ourselves into or out of an idea. I did that multiple times throughout this whole journey here, right? From even back here. Back here, when I first bought it, I had my set of criteria. At that time, I'm trying to follow Can Slim by the book. If you're not familiar with Can Slim, there's a famous book titled How to Make Money in Stocks, written by a man named William O'Neill. Read it. It's a fantastic book. I studied that book and I bought right there. And then my conviction started to build over here. And then I started to find all the reasons why I found one of the ones that were in How to Make Money in Stocks. And this is going to be the life changer. I'm finally going to quit my job. And that was back in 2014, 2014. Didn't finally leave the job until I believe it was 2017, 2018, somewhere in there. Had to make more mistakes first. Right? That's one lesson. Yeah, that's right. Counting the turkeys. That was one of my favorite stories in that book, Counting the Turkeys. We'll talk about that in a minute. Next lesson. It's very easy to find evidence to support an idea. At any point in all of this, there were reasons to buy, there were reasons to sell. There's loads of smart people all over the internet making tons of very logical, very precise, very calculated reasons for why this should be bought, also why that should be sold. How else is price moving all around, right? We're always going to be able to find reasons for the actions that we should take. We should not be hunting for reasons to take a certain action. What we should be doing is having a precise set of rules, precise set of guidelines, precise set of tactics, all guiding how we're going to behave at any one time. Then we could go take a look at what the price is actually doing, look at what our rules say, and then make a decision based on that. And then it's clear, cut, dry, no stress involved, no hunting all over the internet, like this guy back here, right? If you remember, yeah, this guy. You don't need to be like Wile E. Coyote looking all everywhere for the next answer. You have your set of rules, and life becomes a lot simpler. And then finally, big lesson here: blind conviction delivers you to your own peril. If we're blind with conviction, then this happens. Be up, be up big for for about a month, right? That's not that long. That was about 20 days, 20 trading days. That's about a month where I'm up 30%. And then I spend another 2 months giving it all right back. You might think, well, you didn't gain, you didn't lose. Lost a lot of time, lost a lot of mental capital in that time as well. Later on, through the life experience, I was able to glean some very good lessons from this. And that's something else that we should always do. We should continuously journal. We should continuously review our journals. We should continuously learn as much as we possibly can. If we hope to be able to make money consistently from the market, that's the price of entry. We must continuously learn. We must continuously improve. And with that, there's far more information that you guys could get over on my website, marawealth.com. The website is down here, marawealth.com. There's lots of free information on the site. Go check it out. With all that said, let's get to some questions. All right, Jaway. Happy Friday. Let's see here. Happy Friday. Could you share how to control protocol here to 10%, especially when using margin? Even after the stop loss at break even, we still do not want a big drawdown, meaning profit. Yeah, that's right. So let's say that you're in a stock, and now let's bring over some charts here. Here's some more charts. I was doing all this annotating in TradingView here. But let's just say you buy a stock, you see a stock, it looks like a good one. It's going to break out. Here's some of my annotations over here. Just get rid of some of the noise. But this is what I was seeing on this particular day. At this point, I saw the stock here, CWAN, break out on heavy volume. I saw it pull back. It's forming a handle area in here. So I'm going to look to buy right there on this day. And I'm also end up selling right away. I either sold right there or right on the following day. I end up selling this at break even. And you might say, why would you be raising your stop to break even so quickly? Isn't that, aren't you going to be shaken out of a lot of trades that way? Yes, I will be shaken out of a lot of trades that way. I'll be shaken out of a lot of trades that are more likely to underperform by doing that. I just had this conversation with our members, and the conversation went something like this. Think of your trades like employees. If you were to hire someone and on day one show up late, how much leeway are you going to give that person? If you're running the business, I would say get rid of that person straight away. Right? Day one, you're going to show up late, get out of here. If this employee has been with you for a little while, they've already proven themselves. They're performing, they're behaving more like this one is behaving, right? Zscaler. I bought this one back here. It ran up, produced some profits. Now it's coasting a little bit, right? At this point, if I'm thinking of Zscaler as an employee, it's earned a little bit of leeway, a little bit of flexibility. Not complete, but far more than what a brand new employee would get. Here's what C1 ended up doing. I'm out here at break even. Next day, bam. That's going to happen sometimes. Sometimes it'll go the other way. But if a trade begins right away to show us that maybe there's something wrong, it's better to, I find it better to exit, get as many trades to break even as quickly as I can, and then allow them to continue to prove themselves on the way up. Don't give them the leeway early on. They've got to earn that leeway. Hopefully that makes sense. Let's see. Next question from Jawei. All right. Drawdown is also part of the portfolio heat. How do we control that? It's so easy to go beyond 10%, especially when using margin. I think 10%, if we're risking 10% of our capital, right? So there'll be times where I'm fully invested and I might only have maybe 1% of capital at risk, maybe 2% of capital at risk. Well, how do you do that? The way that you do that is by getting your stop to break even as quickly as you can. The true risk is really the distance between where you enter and wherever your stop loss is. Once you raise your stop to break even, then that risk is essentially off the table. Now, if you're holding trades overnight, there's always going to be that potential gap down risk. And so there's a few things that you need to consider for that, right? And some of those things have to do with market conditions. In prior live streams, I've showed you that Venn diagram. In fact, why don't I bring it up real quick? Let me see if I could find it for us. This Venn diagram of the market. Yeah, here it is. You want to be looking through the market with this kind of lens. We're all going to have different things in each one of these circles. You might look at the market in one way. I might look at it in another way. You might have certain elements in your system. I might have certain elements in mine. Our performance, how we trade might be completely different. But if we're looking at the market through this kind of lens, It's going to give us the best chance to be able to see what the landscape is and to be able to adjust accordingly, to be able to size up, size down at the right times. That's one of the ways that I've been able to manage portfolio heat, and I haven't had any kind of a blow up in close to a decade, more than a decade at this point. Since, well, when I turned that corner and started to actually make money with this. This is the reason why. We need to not only know what the trades that we're interested in are doing, but we need to know what the trades that our system is producing are doing as a whole, and also understand what the general market is doing. Is it favoring our system or not? That's going to help us to raise or lower the heat accordingly, to be able to step on the gas or hit the brake at the right times. I talk all about this in the Trading Mind Wheel book. If you haven't gotten the Trading Mind Wheel book yet, for anybody that's watching this right now, go get this book. It's on Amazon. Next year, in the beginning of January, I haven't announced it yet, but I'll announce it for you guys right here. What we're going to do in January is we're going to have a special webinar for this book. And everybody's going to be invited, whether you have read the Trading Mind Wheel or you haven't read the Trading Mind Wheel. We're going to have this webinar, but I would encourage you to go and read the book first, so that way, as we're going through different things that are in the book, you'll be able to come ask lots of questions. We'll be doing this webinar for at least 90 minutes. Go grab yourself a copy. There's hard copy, there's Kindle, there's Audible. Whenever I get a hard copy of the book, I typically like to get the Audible version, and I'll listen and then read along too. The Audible version is fantastic. I'm listening to it right now. Go grab a copy, and we'll have the webinar in January. More questions from Jawei. Jawei is on fire. If the initial stop loss is 9%, that's kind of wide for me, but the initial stop loss is 9%. In theory, we only move the stop to break even after 9% profit. No, I moved my stop up almost immediately. Not immediately, but often the same day. And yeah, that leads to additional shakeouts. But let's see the rest of the question here. But in your example above, it seems you move the 9% stop loss to break even at just around 2% profit. There is no room for the stock. And that's one of the things that people say. That's one of the hangups that I had with that notion for a long time. Oh, we need to give the room stock to fluctuate. Well, in this Chow Wei and everyone else, this is actually where, if we journal, we could go back and take a look at how our best winners performed. Something that I observed about my best winning trades was that the winners would tend to break out and move right away and never threaten the break even at all. The ones that would break out and then futz around the pivot point for a little while, those ones were kind of hit or miss. So then I thought, okay, if they're futzing around the break even, what if I just cut off all of them? Right? Well, why not get rid of those and go for the ones that I know are going to be a sure thing? Ends up dramatically reducing the losses. And here's another thing that I like to do. And I'll show you. I'll draw this out. You may have seen me draw this before, but for the sake of all the new people that are coming here, I'll draw this for you. So, oops, let's move this over a bit more. Okay. So, you have your distribution, wins on this side and losses on this side. This middle bar right here, that's 0. So let's say you get a win. And then let's say that you get a loss. This is your standard win, your standard loss. At that point, you're about even, right? But instead of your loss being over here, what would happen if Let's say your loss was there. Well, your win, you're still in the win column, you're still making money, but your win has to dig you out of a hole first in order to start moving. What happens if you get a couple of losses in a row over here? Well, then your wins need to do more digging out of that hole, right? The closer our losses end up being to zero, the better. Then we're not going backwards. Then our wins are able to pick us forward. So it's not about having loads and loads of trades. You could have 100 winners, you could have 100 losers. But what if you're able to get more of those losses to zero? Where, let's say you end up with, instead of 100 wins and 100 losses, you end up with 30 wins. You end up with, say, 30 losses, and the rest of them are all break even. But the winners end up being the best ones because they didn't threaten your break even point at all. You end up with more money in your pocket. That's what you end up with more. Other thoughts or comments or questions? Actually, it's 12 o'clock and we're out of time. So hopefully you found this helpful. If you did, please drop a comment down below. Let me know if you enjoyed the show. Make sure that you like and subscribe to the channel. And if you want more information, head on over to marwealth.com and get some more free education. Till next week, I'll see you then. Take care, everybody. Much love. Peace out.